bargain element.
Spicy.
The bargain element is the difference between the stock price on the day you exercise and the price you paid for the share. So if you paid $1 for the share to exercise it, and the price on that day was $5, your bargain element is
$4 per share.
That is correct.
All right.
You win a Street Fighter game console.
Okay. This is only relevant for those of you with incentive stock options. The bargain element for non-qualified options would determine how much shows up in your paycheck, but they don't really call it bargain element in that space. It's just for
incentive stock options.
Right.
Yeah. And when we calculate your alternative minimum tax, we're just taking the bargain element per share, multiplying it times the number of shares that you exercised.
And that increases your alternative minimum taxable income.
Yep.
We'll talk about that in a separate video. Fair market value.
FMV?
FMV, yeah. This is some jargon that you'll see floating around. You might see it in our emails, you might see it on some websites. Fair market value is just how much a stock share is worth at the time. So it's the fair market value. For public shares, they're all traded millions of times a day, but for public companies, their shares are traded all the time. So we know the fair market value because it's what it last transacted at. It's more difficult to know what the FMV or fair market value is for private companies because they don't have public disclosures of all the sales that are happening. So, it's often called a 409A valuation would be the fair market value at that time. We're going to describe in detail what a 409A valuation is in a separate video. We just want to describe what FMV is today because it's used very often in tax jargon.
Yep. And the FMV of your shares could be the same for the first 3 years of you having those options, right? It could not change until the company's ready to raise money. So FMV could be static for a long time.
Look at you tax jargon knower.
Strike price.
Ooh.
Strike while the iron is hot is what we like to say. It still looks like fishing, yeah. The strike price is what is listed in your grant document. That is the price that it costs you to exercise or to purchase a share. That is the strike price equals the fair market value on the day that you get granted that option. A lot of jargon in there. But
yeah, that was thick.
Yeah.
What you need to pay for the share, per share.
Pretty much.
Right. 409A valuation.
Not to be confused with 409, the wonderful cleaning product.
Right. Yeah, right. 409A is, we described a fair market value in another video. We referenced the 409A there. Essentially, the 409A value is within the Internal Revenue Code, section 409A.
So creative in naming things. 409A, 401K, it's just the line of code.
Yep, that's when lawyers and accountants get into naming things. It doesn't get very easy to understand. Thus, this topic that we're discussing now. So the 409A valuation, it's a code section. How it's relevant to you is when a company is private, the board of that company needs to determine what the fair market value of their private shares is. They usually bring in third-party experts to come in and say, all right, this is how many assets you guys have, here's your liabilities, here's your chances of growing. So the value is kind of arbitrary because no one's buying and selling at that price, but it has been determined by a third-party expert that it should be $5 a share. It's
kind of like a pawn shop, right? When you bring in a watch, you need some cash right away.
Yeah.
The expert at the pawn shop is going to say, well, this watch is worth $100. That's the fair market value, or the 409A if you're a private company.
Yeah, and it's very important for pre-IPO tax decisions whether we're going to exercise options because the difference between the 409A and your strike price is going to determine the size of the taxable event. So we need to know it. It's often hard to get it. Companies don't like to share it too fairly often because it can change. It can change internally.
It can change overnight. If there's a round of funding raise, the 409A could go up or it could go down, which we see all the time.
Yeah, and if you know that a 409A valuation is coming up, it's a good idea to talk to us because that could dramatically change the impact of exercising shares, RSU'S, all that fun stuff. So please know what the 409A value is before we decide how to handle your equity comp because we need to know that. It's just required, otherwise we can't help you.
Yep. Exercise. Haven't done that in 6 months.
You're filming this in the middle of COVID, by the way, for reference. An exercise is when you exercise your right to purchase an option, right? So when you started out your company, they gave you a grant which allows for the option to purchase a share of stock in that company, the company that you work at. When you exercise your right to purchase that share, that's what exercising is. That's just a jargon word that we want you to be familiar with because it's very important.
Yeah, and just by exercising it, that means you hold the share, right? Exercise and hold, that's a strategy we're going to use for your ISOs.
Yeah, very important. A lot of people don't know this. You do not own shares in the company's stock if you just own the option with the right to exercise it. You own the stock after you exercise your right to purchase that, and you pay out of pocket the strike price.
Yep. AMT, or the alternative minimum tax, or as we like to call it, the awesome money taker.
Okay. I am amped
for this discussion.
No P, to explain the alternative minimum tax, the AMT, to you guys today. So the AMT, as if taxes weren't complicated enough, we all are exposed to the AMT. Everyone is. We all pay a regular tax, but if that tax isn't high enough, then the alternative tax that is calculated in the background, if that minimum, after its calculations, exceeds our regular tax, then we need to pay it. Okay, who is this relevant to? This is relevant mostly to people. I mean, it's calculated for everyone, but the reason we're talking about it as an equity niche company is that for those of you with incentive stock options, the alternative minimum tax is a boogeyman that we need to watch out for.
Yep. Because if you have incentive stock options, right, we don't pay regular income tax on the exercise, but the bargain element, which we defined elsewhere, shows up in our calculation for all our alternative minimum taxable income. So in regular income tax land, we have a $100,000 salary, that's cool, but we also generated a bargain element of $50,000. So in the alternative minimum taxable universe, we would have taxable income of $150,000. Got an analogy for you.
Okay.
Seen the show Stranger Things?
I've seen it.
Right. So regular universe, right? That's the normal taxation.
I see where you're going.
But then there's the upside down, which is sort of like the shadow creepy world, which is always happening, right? It's always going on underneath the surface.
Okay.
That's the AMT. Those are like the greasy, grimy, alien netherworld is the AMT.
Cool. Yeah.
So we'll do what we can to help you avoid it.
No one likes it.
Yeah.
Why is it there?
Not tight. not a good
Thanks, Congress.
But no, the AMT was originally, the reasoning behind the AMT was designed to catch wealthier people who were using all these tax strategies like investing in oil drilling partnerships in Texas. The AMT was designed...
Home mortgage interest.
Exactly.
All these deductions that are carved out for wealthy people.
Exactly. So the AMT brought all those deductions back in. Unfortunately, ISO exercises are one of those, what we call preference items. So those are, unfortunately, a lot of our regular tax-paying folks are going to pay AMT when we're exercising equity comp.
If you've got ISOs with a large difference between your strike price and the fair market value, we got to talk about AMT with you.
Yep.
Minimum tax credit is if you have exercise incentive stock options and you've paid the alternative minimum tax, to prevent you from paying double tax on the sale of your incentive stock options down the road, you get what's called a minimum tax credit carry forward, okay? And what this is, suffice to say, if you pay alternative minimum tax on your options, you get a tax credit carry forward for the amount of AMT that you paid, and you can take that credit against regular income tax in the future. So if you do pay AMT, it's not all lost. You actually get a carry forward. Yeah. Right?
So you can earn almost 100% of that AMT that you paid this year back in future years. It's not going to be next year you're going to get 100%. There are some limitations that we'll go through with you when we meet in person. But that AMT is not lost, and that's very unique in the tax space.
Let's do a quick example. I'm going to do a quick example. Let's say you paid $50,000 of AMT on an ISO exercise in the year 2021. Okay, so you're gonna have a $50,000 tax credit carry forward to the year 2022. Okay, in 2022, if your regular tax is $40,000 and your alternative minimum tax is $30,000.
Because you didn't exercise ISOs, right?
Back to normal at this point. So we got a $10,000 difference between our regular tax and our AMT. We can take a tax credit, that minimum tax credit, down to our AMT. So we can take $10,000 of a credit out of our $50,000 carry forward and reduces our bill, so it helps us out. And then we have a $40,000 credit carry forward to 2023. So it gets carried forward. And that's why it's really important for us to do multi-year tax planning and tax strategies and to keep track of those things. We have found minimum tax credit carry forwards that were not carried forward, and we find them and then we get them back on the tax return, and we survive them, we resurrect them, bring them back from the dead.
Yeah, and that's why we ask for all of your prior year tax returns, because we want to make sure that whoever prepared it, maybe it was you, maybe it was an accountant, actually made sure to list that minimum tax credit in the background of their return. You know, what happens all the time, which is no one's fault, is that you change tax preparers and you start a new relationship with someone, and maybe they didn't get the full copy of your 2016 return,
or they don't know what they're doing,
or they don't know about it, and the credit just gets missed. And that is, you know, free money that your, you know, treasure hunters, your tax excavator, adventurer, Indiana Jones types like ourselves can go back and help you find. So that's honestly one of my favorite parts about this. We love going back into tax returns and looking for that minimum tax credit.
I'm imagining you with a bag of sand trying to get that minimum tax credit and snatch it out.
That happens.
And then the IRS is the big ball that comes.
Oh, but yeah.
And
all right, now that's not
okay. That's the minimum tax credit.
Basis.
Yeah, I mean, it's just a tax jargon word for what you paid for something. Most people are familiar with basis. You can replace the word cost. We call it cost basis sometimes even. Most people are familiar with if you buy and sell a house, right? Most people are familiar with gains on houses. Your parents probably talk about it. I bought that house for a pack of cigarettes in 1971. I don't know if your parents are from Mississippi. And then they sold it for a gain, right? And they're excited about the gain they have on their house. The cost basis, or the basis, is if they bought it for $100,000 in 1971 and then sold it for $300,000. The gain is the $200,000 difference. We care about it because we need to make sure that we don't pay taxes on the full proceeds on a sale, but the difference between the basis and the proceeds.
And one thing that we got to watch out for is that often a brokerage like E-Trade or Morgan Stanley is not going to know what your basis is.
Yep.
Because their computers, when there was a transfer 5 years ago, reported the basis as zero. When we know that you paid something, you did an exercise, you used cash, so there is basis somewhere. So often what we're going to do is we're going to help you reconstruct that basis, meaning we're going to look at your history of exercises, the date that you exercised, the fair market value on the day that you exercised, and we will then report to the IRS what your true basis is to actually reduce the taxes you owe.
Yep. Some of the other idiosyncrasies here is the basis for RSU'S is how much showed up in your income. Okay, so you paid tax on that already, so if we were to sell that down the line, we don't want to pay that again. Right, so if it showed up in your income in the past, it is in your basis. And in a similar vein, for ISOs, you can have a different basis for regular tax, incentive stock options, than you can for alternative minimum tax. If you remember the bargain element, another video on that, when you exercise, video on that as well, that word, when you exercise your ISOs, the bargain element shows up in your alternative minimum taxable income, therefore you have a different basis for AMT than you do for regular tax. Okay, so when you sell those shares down the line, you're gonna have to do the math on the differences on the gains in the two different, what'd you call it before, the upside down?
The upside down, yes, exactly.
Yes.
In the Stranger Things upside down world.
Than for regular tax. So if you're heading down that road, we're here to do those calculations for you. That's what you've hired us to do, so we're happy to do it.
Yep. Vesting.
Right.
Do you wear vests?
Divest, invest, just reg vest. A lot of vests, no.
So vesting is usually when you get hired by a company, they are going to give you a grant of RSU'S or options, but they're not going to give you everything on day one, right? Because you would
There's no incentive to stick around.
I take the money and run, right? So they set up a vesting schedule, meaning that you need to fulfill an obligation. You need to work at the company for a certain number of years or months in order to have those shares fully vest. So when you're fully vested, you have fulfilled the obligation of the preset term. Usually we see 3 or 4 years. It's a pretty common vesting schedule, or that's the vesting term. Within the term is also a schedule. So most common is quarterly. So 4 times a year, you're gonna have a certain number of shares vest. We also see monthly. If they would make things easy for us, it would be annually. That would be a lot easier to report, but not as great because we would be looking at different, that was,
it's fine.
Yeah.
It would be easier annually, but
yeah.
You'd have to wait a whole year to stick around for the next vest instead of like on a monthly basis. And next month they get more, next month they get more. Keeps you coming back to the trough.
Exactly. And vesting schedules we often talk about the golden handcuffs of equity compensation.
Yep.
Is that your vesting schedule, if you got a big fat equity award that's worth, $200,000 today, but you've got a 4-year vesting schedule, it's going to be pretty hard for another company to convince you to leave that $200,000 or that potential to earn $200,000 on the table.
Let's not forget, you can have one vesting schedule for one grant. You can have another one that overlaps with that. You can have a Venn diagram of overlapping vesting schedules that are going to have interrelated complications and tax issues, income issues for you that we're here to help you figure out.
Yep. Qualified Small Business Stock, QSBS.
Section 1202 of the Internal Revenue Code defines qualified small business stock. What is it? It's complicated, but essentially, without getting too far into the weeds, if you've got stock from a small business that you've owned for a long time, generally 5 years, you can exclude the gain on the sale of that stock, right? So from your income taxes, and you won't pay income taxes on it. So we had a client that founded a company recently, or founded it in 2010. He sold his stock in 2019. He made $600,000 on it, didn't pay any tax on the sale because he owned it since he founded it, and it qualified for the qualified small business stock exclusion. It is limited to $10 million over the lifetime of an individual's life, so you can only exclude up to $10 million right now. There are opportunities to shift some income to your spouses and children, which is a super advanced strategy that we've employed before. But suffice to say, what you need to figure out is the value. If you want to try to qualify for QSBS, what we've seen is our clients go to the old CFOs or the old finance team from their companies from when they were granted those awards, whether they be non-quals, RSU'S, whatever it is, and confirm that they qualify. Because there is a size of the company limit. I think it's $50 million.
$50 million,
yeah, is the size of the company. It can't be worth more than that, so you add up all the shares that are distributed among the shareholders, and you add the value up. And if that's less than 50 million, then that was a small company, a small business in the eyes of Congress. So that stock forever has the tag, so to speak, of being qualifying for QSBS. So when you sell it, you can exclude the gain. We've amended returns for clients that didn't realize that their sales in the past qualified. We have tagged stock that qualifies. We figured it out for them.
Yeah, and a couple things to know is you don't have to have founded the company, right? You just have to have been granted the shares at the time where the company was a qualifying entity.
Yeah, there's a lot of restrictions. We'll dig into it if you think that you qualify.
Yep, exactly. Blackout period. Not the kind of blackout you're thinking about.
Oh my God. Blackout period is a period of time wherein insiders at a company cannot sell shares of their stock. So you work at a company, you develop the products, you're familiar with the financials potentially, you know about the acquisition plans for the company. There's all kinds of things that are what the SEC calls material non-public information that you know but outsiders don't, that would impact the financials of a company, right? Insiders can be anyone from middle management up. It can even be associates in some cases, like just brand new hires. Most people that work at these companies experience blackout periods.
Yep.
These are periods where, because you have non-public information, you are not allowed to transact in the stock until that information is disseminated into the market in general, so that everyone knows about it and that we can all play a fair game of buy and sell in the stock market, which is just a giant flea market, essentially. People buying and selling stuff rapidly. Yeah, so the way that these periods work, do you want to explain like generally when blackout periods exist?
Yeah, we can actually try to predict your blackout periods because they usually follow an earnings call, right? After a quarter happens, the finance team gets together, they put together reports, and they actually get on a phone call and they talk reporters and investors through what happened over the past quarter. So all that information has been private, then it is public, and during that quarter, the blackout period is enforced, right? So after the earnings call, a trading window will open up for the employees to transact. Usually we can predict those trading windows. You'll probably get an email a couple days before saying, all right, our earnings call is happening on the 25th. The blackout window is going to end, the blackout period is going to end 2 days later on the 27th. Your trading window will open, and it's going to be open for anywhere between 2 and 4 weeks. So, blackout periods are generally scheduled almost a year ahead of time. You can look it up on Yahoo Finance when the earnings call is going to be, but they really do kind of shift around last minute.
Yeah, or the investor relations tag on your company's website. That's what that's for, is to deal with the SEC disclosures, that dissemination of the private information that you currently have, if any.
Yep. RSU'S, restricted stock units.
Yes. Let's break that word down. Restricted and stock units. Restricted means that you got to work somewhere for a certain amount of time before that grant, that award of stock units is yours. And what do you receive? The stock units. After that time passes, you get the units, some shares in your company. And what happens when you receive those shares? The value of them shows up in your income. You pay income taxes on them, just like wages that you've earned, whatever the value of that company is worth on that day, times the number of units. It's like wages that you earn.
Yep.
You pay taxes on it. Now you have the shares. What do you do next? That's what Brooklyn FI helps you with.
A non-qualified option is the option to purchase shares in your company at a predetermined strike price. So you get a grant with the number of options you get. What are you going to have to pay for those shares? When you do exercise that non-qualified option, you are going to be taxed at regular income tax rates on the difference between the price you paid, that's mentioned in the grant, and the price of the stock on the day that you decide to exercise it. You have control. You get to choose when you exercise it. That's why we like non-qualified stock options so much.
Look at you, day trader. Incentive stock options, or ISOs. What are they? What are they for? Incentive stock options are stock options that allow you to buy a stock at a preferred price, and they have incentives to allow you to get preferred tax treatment on them. You won't pay any regular income tax on these options like you would for non-qualified options. You won't pay any income tax on these if you play your cards right. And we're here to help you play your cards.
Yeah, it's a waiting game. We gotta satisfy a certain holding period. We gotta time it right. So it's a multi-year strategy to pull off a perfect incentive stock option exercise and sale. And we can help with that.
Yeah.
10b5-1 plan. Ooh,
Is that a phone number?
It's my phone number. No, don't call me. A 10b5-1 plan is usually implemented by executives at a company who have material information. So if I'm the CEO of a company, I know all the acquisitions I'm going to make over the next couple of years. I have material. I know a lot about the trajectory of the company. So it would be unfair for me to trade based on that information. So a 10b5-1 plan is basically you laying out all of the buys and sells you're going to make over a certain time period. So you tell the SEC and the wider public exactly the moves you're going to make before you make decisions about the future of the company. It's a document you got to sign. It is public information if you work for a public company. We think they're great. We actually create mock 10b5-1 plans for our clients, even if they're not CEOs and CFOs, because we believe in setting a trading plan and sticking to it. So we'll build one for you, and you'll know exactly which shares to trade on what date for the next couple of years.
Cool. Yeah. I mean, I'm assuming if you are eligible for a 10b5-1 that you know what blackout periods are.
Yes.
But if not, we have a video for that too.
Yep.
Section 83B. First of all, we need to understand, before we explain 83B, we need to understand restricted stock. Okay? The way that restricted stock works is that you will receive a certain amount of shares that vest over a period of time, and every time they vest, they will show up in your income. Okay? And that could be over the course of 4 years. All right. So if you are someone that's receiving shares from a brand new company, it might not be that big of a deal that they're showing up in your income. Could be a few $1,000s. You pay tax on that, even though you can't sell that stock because it's still private. But let's say that the company becomes a unicorn. You're working at Peloton. You're working at Airbnb. You're working at Palantir, somewhere where the company's trajectory just explodes and the value goes up a ton over the course of just a few years. I guess with Palantir that was like 20 years. But what could happen is that when those shares vest, it wasn't previously an issue because the value of those shares wasn't that much, but now you've got sometimes 6 figures of income showing up on your income tax return. You're paying taxes on them, but you can't sell these shares because you're not public yet. One solution for that is what's called an 83B election. So right at the beginning, at the grant, when you first were awarded that restricted stock, you can elect to accelerate those 4 years of vest, the value of all those, it could be $10,000 now, into or onto the current year tax return into the current year, and you pay taxes on them now, so that when they become a unicorn, you don't have to worry about all of that income showing up for an illiquid position that could potentially, bankrupt you, put you on
Totally.
on an installment agreement with the IRS. You owe the IRS money, you can't pay it. 83B prevents all that by accelerating income. The risk is that you accelerate all that income onto your tax return that year, and then yes, the value goes down, or you get fired, it happens, and you've paid taxes on a bunch of shares that are never going to vest for you because you've been terminated.
Yeah.
So you can't get that money back if that happens.
Also with an 83B election, it's really important to make the election within 30 days of the grant. It's so valuable that the IRS has put very strict limits on it. It's not available at any point. It's when you get the grant, call up your accountant and have them file the 83B election right away. We're writing a letter to the IRS to let them know that, hey, we are making this election. We're paying taxes now. Don't bother us in the future.
It's also, it's more of a niche thing, but it's also available for incentive stock options to accelerate the alternative minimum tax that you could be exposed to on those ISOs. Pretty rare. We don't see that very often, but it comes up, so.
Yeah. It's risky to pay tax ahead of the time that it is actually due, but a lot of times a successful 83B election can pay off quite nicely.
Yeah, it's another reason why having dry powder or cash laying around to handle your equity compensation is really valuable. Because if you can't afford the 83B, pay all that tax, accelerate that tax now, then you could be exposed to some really dire consequences in the future. So 83I election is available for those of you that have RSU'S or non-qualified stock options, and your company is not public yet. So one of the main threats when it comes to taxes, cash flow, and equity compensation is that you exercise a non-qualified option or an RSU vests and you have a ton of income that shows up on your tax return, but you don't have an asset that you can sell, right? Your non-qualified options or your shares or your RSUs are for a company that's not public yet.
There's no market, no one wants to buy them yet.
Yeah, so you're jammed up, essentially. So no one likes getting jammed up.
You're caught between a rock and a hard place, really.
Right on. So to alleviate that pain in cash flow and taxation, there is what's called an 83I election that Congress recently created with the Tax Cuts and Jobs Act. And what it does is it allows you to, when you have a taxable event, such as an RSU vest or a non-qualified option exercise, you can make an election, an 83I election, to defer paying the tax on those taxable income events for up to 5 years, the earlier of 5 years, or the IPO of your company. At which point, you've got a liquid event, you've got a liquidity option, and the 5 years means that you've been able to save up time and cash, hopefully, to pay your bills.
A liquidity event is not what happens 5 o'clock somewhere.
No, liquidity event is when something that was previously illiquid, such as private company stock, suddenly becomes liquid. What does that mean? It means that you can sell it, right?
It means that someone suddenly wants to buy it, is really what it means, right?
Yeah.
A market is
Opportunity
created
to
for
sell.
that.
The biggest liquidity events, there's two main ones, right? There's 2 or 3 main ones. The big one is an initial public offering or an IPO for a company that's been previously private and now is public, which means that there are going to be thousands, maybe millions of transactions buying and selling of that company's stock on the stock exchange, whether it's New York Stock Exchange or the NASDAQ, doesn't really matter. You can exchange your stock for cash or for other equities whenever you want at that point. Whereas previously to that, you could really only sell to probably back to your company first, would be the first person that would have the right to buy that company back, the right of first refusal. Or if they did bless it, you could sell your shares of your private company to a third party, such as through like an equity Zen transaction or like a venture capital firm or some other company that wants to get in on that company that you work at prior to that company going public because they have faith in the performance of that company.
Mm-hmm. Yeah, and another liquidity event could be an acquisition, right? That's
Yeah.
not as sexy as an IPO. You're probably not going to get quite the multiple that you would from your company going from private to suddenly being available to publicly trade, buy, and sell. But a liquidity event where another company absorbs your company, purchases your shares from you for 2, 10, 20 times what you paid for them, that's also a pretty good opportunity to exit, walk away with some cash after you pay the taxes, and get on with your life.
Such as a Microsoft buying a GitHub.
Yep.
Or a Morgan Stanley buying an E-Trade.
Or Amazon buying a Whole Foods. You know, these are sort of the famous acquisitions we've seen in the past couple of years. But an acquisition is a perfectly respectable liquidity event to get out of holding those shares.